Now, I have said that we are going to be looking on the capital allowances stroke deductions. They are normally called capital allowances stroke deductions. And sometimes you might be asking yourself, why do we have to calculate the capital allowances? I say the capital allowances are granted. They are normally granted instead of depreciation. They are normally granted instead of depreciation, right? They are normally granted instead of depreciation as a compensation, as a compensation for the loss, as a compensation for the loss in value of assets, as a compensation in value of assets repeatedly in business, to generate taxable income, I remember this is the thing that I was able to explain the first day we started doing taxation, and I was able to tell you that the depreciation is normally not accepted, or it is not appreciated by the tax, and therefore that is where we are saying that rather than calculating the depreciation on the loss of value of their assets, we normally calculate the capital allowances, and that is the one that is normally done here. And sometimes you might be asking yourself, what are these capital allowances? They are normally grouped into around 6. They normally include, right? Number one, we normally have investment deductions. Sometimes you will be able to see writing ID, right? ID meaning investment deductions. And we say that it is normally granted, the investment deductions is granted. Investment deduction is granted to manufacturing assets. It is normally granted to manufacturing assets. Right? At the rate of 50% in the first year of use, and 25% in the residue value. These are very key, but they are normally given in your question. When you look on the front page of your question paper, you'll be able to see these rates being given. So in this case, the manufacturing assets are normally granted at 50% in the first year of use. So every asset that I could see qualifying for investment deductions, I'll be able to grant a 50%, that is the investment deduction at 50% of the qualifying cost, which is the cost of purchase of that asset in the first year of use. Then the balance will be granted 25% 25% of the residual value using the reducing balance basis. Now, such assets normally include, right? Such assets include, what are these assets which normally qualify for investment deductions? Such assets normally include, we normally have what? We normally have a factory building. We normally have processing machinery, right? We normally have water pump, right? Sometimes you might be asking me why about the water tank. I will be able to show you where it falls. We normally have conveyor belts. Right? We normally have air purifier. And any other asset that qualifies here, we have silencer, right? We also have workshop machinery. workshop machineries. We normally have sewerage treatment plants, sewerage treatment plant, etc. etc. They have very many, and we shall be able to see them in your past paper. We shall be able to see them in your past paper. So that is why we are saying it is granted to the manufacturing assets at the rate of 50% in the first year of use, and 25% will be, and then I have given you the examples. So when you see all these assets in a question of the investment deductions, you will be able to understand they qualify for capital allowances under investment deductions. Now, the most important thing that you can be able to relate here, I think I can be able to add more, much of the assets here. We talk about drainage system, right? We have borehole. We normally have borehole. We can also talk about parking and loading bay. Parking and loading bay. We have perimeter walls. Perimeter wall, among any other assets which we think, even the bridge. Bridge normally qualify here. Bridge, etc. etc. Those are the assets which normally qualify for investment deductions. Number two, we normally have industrial building deductions. Industrial building deductions. In other terms, it is normally called IBD, right? It is normally called IBD. And we say that it is normally granted on non-manufacturing assets. It is normally granted on non-manufacturing assets. Non-manufacturing assets, right? Non-manufacturing assets on straight line basis. On straight line basis at the rate of 10%. At the rate of 10% per annum from 1st January 2020. 1st January 2020. Now, we can be able to look on the examples for these assets. They normally include, warehouse. They normally include warehouse, right? Staff quarters. Staff quarters. We normally have staff clinic. Staff clinic. We normally have canteen. We normally have gym, right? We have gym among any other assets. We have a lot of assets here, which we shall be able to check on, etc. 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 Now, we are saying that, we normally say that because here we have to be identifying and elaborating much about this, we say that in case of a building, we say that in case a factory building, right, holds the costs or holds the following assets, or hold the showroom, right? We have showroom. We normally have retail shops, right? We have caretaker's dwelling house. Caretaker's dwelling house. Caretaker's dwelling house. And administration block. administration block, I'll be able to tell you, calculate a 10% test, right? To check whether the cost of the above assets qualifies for IBD at the rate of 25%. At the rate of 25%. So in this case, it means I have to teach you how to calculate a 10% test. So if it is above, right, here we'd say, if it is above 10%, subtract the cost of the assets from the factory, from the cost of the factory building. So it means if it is above 10%, when you do this calculation, when you do a 10% test, if it is above 10%, you subtract the cost of the above assets from the factory building. It means they qualify for IBD, right? But if it is less than 10%, you are not going to subtract them from the cost of the factory building. The total cost given of the factory building will automatically qualify for ID, and you are not going to be subtracting the above cost of these assets. I will be able to show that I have a question of that criteria. I have a question for that criteria. Now, I just want to check on. I just want to check on the other capital allowance. Just want to check on the other one. Let me check on the other one. Sio lazima hata leo iko ya mwisho. We can just do this, we do another one another day. Don't be shocked. Don't be shocked. We are here until you pass your exam. Now, the third one will be wear and tear. Wear and tear allowances. Wear and tear allowances. It is normally called WTA, right? WTA. And we say it is granted on non-manufacturing. It is granted on non-manufacturing assets, right? Non-manufacturing assets, right? On reducing balance basis, on a reducing balance basis. On a reducing balance basis. And we can be able to say, when calculating WTA, when calculating wear and tear allowances, right? Assets are grouped into two. Assets are grouped into two, right? Now, we normally have, or we can talk into two main classes. Because we are dealing with classes here. So let us start with class 1. At the rate of 25%, right? I remember we had some notion before, whereby the wear and tear allowances had 4 classes before. But after the revision, during the COVID period, they were able to be revised. So they revised the classes into 2. So we normally have only class 1 and class 2. So class 1 incorporates the whole structure which carried class 1 to class 3. Now, in this case, we are just saying it includes the assets with the following characteristics, but that is not the case. It includes the assets qualifies for capital for wear and tear class 1. They include assets includes, right? Number 1, we talk about Caterpillar. We have Caterpillar. Caterpillar. I think it is normally written like that, right? We have tractor. We have bulldozers, right? We have combined harvester. Combined harvester. I think it is okay. You are seeing what I'm writing. Combined harvester. We have forklift. We have forklift. We have forklift. We have lorry of 3 tons. Right? Lorry of 3 tons and above. And below, I should say, and below, because they were all combined here. 3 tons and below. We normally have office electronic equipments. Office electronic equipments, which normally includes electronic equipment that defines an office. We normally have computer. We have computer. We have photocopier. We have photocopier. We have printer. Tuko na ETR, right? We have scanner. We normally have calculator. We have calculator, duplicating machine. Duplicating machines. We also have electronic paper shredder, among others. Shredder. Electronic paper shredder, among others. Any other assets which qualifies for class 1, we normally have assets that are self-propelling. Assets that are self-propelling, which they normally include pickup, which include, we normally have pickup, right? We also have saloon car. Saloon car. We have tuk-tuk. We also have motorbike, right? We also have limo, limousine, aircraft, delivery van, we have staff bus, etc. Now we say NB here. I say in case of an uncommercial. In case of an uncommercial vehicle, this vehicle, it is called saloon car. In case of an uncommercial vehicle, which is saloon car, the qualifying cost is restricted. The qualifying cost is restricted. Is restricted to Kenya shillings 3 million. What does this mean? If you can be able to purchase a saloon car above 3 million, the amount that qualifies for this saloon car is 3 million. For instance, if your saloon car is 4 million, right? The one that you will be able to restrict that 4 million to 3 million. 3 million is the one that qualifies for capital allowances. We don't allow above 3 million to qualify for capital allowance, but below, come on, 28, you put 28. But if it is above 3 million, that does not necessarily qualify for capital allowances. There is another asset which I was able to forget there, where we discussed about websites. We normally have websites which normally qualifies for class 1. We have computer softwares. Kitambo, they used to have special classes, but they were all grouped into one. They were all grouped into one class. Then I just want to look on class 2 because this was class 1. Let us look on class 2. Class 2 at the rate of 10%. Class 2 at the rate of 10%. And we say it includes, it normally includes any other assets, which do not, a minute please. Which do not qualify for the for class 1. Let me put it like that. Any asset which does not qualify for class 1, any asset which I have not categorized here qualify for class 2. And in this case, I say they include number 1, they normally include furniture and fittings, right? The other one which normally qualifies here, we have fax machines. We normally have neon sign. There. We normally have partitions. We normally have office carpets. We normally have wheelbarrow. Right? We have bicycle. We have curtains. Right? We have generator. Generators qualifies here. We have water tank. Water tank qualifies here again, etc. Those are the assets that you need to be able to converse yourself with. They are mostly the first 3 investment deductions are the mostly tested at your level, right? At your level, the examiner will be able to check on the 3 investment deductions, or not the investment deduction, but the capital allowances. The 3 are mostly tested in your exam. The others I will be able to write down there. But before I introduce you to the other ones, I just want to write the points to note. Points to note here, which is very simple. And in which even you can see in our previous semester, the examiner tried to mislead the students. The NB for me here, which I'll be able to give you, NB, I'll be able to tell you that land does not qualify. Land does not qualify for any capital allowance. Land does not qualify for any capital allowance. There is no any area you will be able to tell me that we are going to be having, right? We are going to be having capital allowances for land. We don't do that. And we say also, number 2, this is number 1. Number 2, we say ID, right, is granted at the rate of 50% in the first year and 25% the residue value. Right? That is number 2. The NB number 3, we say there is a 10% test which is normally done. Right? And we have said very clearly that this applies to the cost of showroom. It applies to the cost of showroom, right? Retail shops normally applies to the showrooms retail shops, we have offices, we have administration block, right? We normally also have caretaker's dwelling house, etc. Now we are saying that the above items, right, if included in the factory building, will only qualify for any capital allowance, will qualify for any capital allowance if their value, does not exceed what? Does not exceed 10% of the total cost of investment. Of any total cost of investment. So this is the thing that I will be able to do for you. I'll be able to show you how to calculate the 10% test. And I will be able to show you when do they qualify for IB and when are they supposed to be qualified for IBD, right? These points are just clarifying what you're supposed to be doing, right? And it is clear that I am supposed to be understanding that these are clear points in which they can be able to guide me pass my exam, right? And also be able to understand how it should be done. Other capital allowances, they normally include, right, which are not very important at your level, but I will just be able to state them. Number one, we have farm works deduction. It is a question under advanced level. Farm works deduction, which is normally written like this. Then the other one is a mining allowance, which is our MA, right? And then the last one, it is shipping investment deduction. Shipping investment deductions. It is normally called SID. Those are the capital allowances in which tunapaswa kupigana nazo. Those are the ones that we need to familiarize ourselves with as we move forward. I just want now to be able to show you how to do capital allowances, which is a critical thing for you. And I just want to start with simple questions, be able to show you how to calculate the capital allowances. I will just start with 2015, moving forward, which I think is very important. Let me start with 2015 November. 2015 November, you can open your past paper, and then I will come until I do last semester's question, which will be able to guide you on how we normally do capital allowances. We knew you are the one to start reading for us today. So we have a question November 2015, question number 4C. The question is here. Pesa Limited. Winnie, you can read for us.
Pesa Limited commenced manufacturing on 1st of January 2014 after incurring the following capital expenditure. We have Factory building, not 8 million. Processing machinery, 2.4 million. Saloon car, 2.8 million. Neon advertising sign, 48,000. Computers, 150,000. Delivery van, 960,000. Furniture and fittings, 200,000. Water tank, 90,000. Water pump, 40,000. Computer software, 120,000. And lorry, 3 tons, 2,750,000. Additional information. Number 1, factory building include a dwelling house of 1,180,000 and a commercial building comprising an office of 1.2 million, a shop of 800,000 and a showroom of 600,000 shillings. Number 2, processing machinery excludes an interest of loan and an interest on loan of 240,000 paid for a loan of 2 million used to acquire the machinery and installation cost amounting to 60,000. Number 3, the saloon car was disposed on 1st of December 2014 for an amount of 1.8 million. A staff canteen constructed during the year at a cost of 840,000 was put into use on 1st of September 2014. A section of workers' quarters burned down by fire had been renovated at the cost of 1.5 million. The remaining section, which was not affected by the fire, had been valued by an insurance company at 1 million shillings. The workers' quarters were reoccupied on 1st of October 2014. Required capital allowances due to PESA Limited for the year ended 31st December 2014.
When you look on this question, it is very critical and very simple, in which you can be able to check on the way I was able to give me my notes. You can even do the question on your own. But in this scenario, because already I need to master where certain assets qualify, this is what you normally do. Let me just give you a solution for this. So this is what we normally do. The first thing that you have to do, write the title. So we are discussing about PESA Limited. Right? PESA Limited. PESA Limited, we are doing the capital allowances for the year 2014. So here you write down 2014 capital allowance. Capital allowance is computation. Capital allowance is computation. And because I told you in your level, the examiner normally focuses on the first 3 that we have tackled, I will start with ID, investment deductions. So what I'm going to be recording down here, we normally record the nature of assets, the qualifying cost of the assets. We have said the investment deduction is normally granted at the rate of 50. Then we are going to be having the residue carried down, which normally which will be given the residue value at the rate of 25%. So what will be the residue carried down for the first year? That is the first question that you are supposed to be asking yourself. Now, when I look on the question, I will be able to start with the information given there. The first thing that I know, the ID is normally granted to manufacturing assets. That is the thing that I know. So it means my first asset given by the examiner is the factory building. Factory building. But even the examiners notified me, this factory building, I'm supposed to be very much keen because there is an additional information in regards to my factory building. In note number 1, the examiner says this: factory buildings includes a dwelling house, of 1.18 million, a commercial building comprising of an office block of 1.2, shop of 800,000, and showroom of 600,000. So how am I going to be doing this? I'm supposed to be checking on 10% test. Let me check on 10% test. I'm supposed to be taking 10% test to know whether I'm going to be taking the whole figure, the whole qualifying cost given for the factory building, or I will be able to subtract these assets because they qualify for IBD. If the total amount of these assets is greater than the 10%, if it is less than 10%, tungeweka hapa the whole amount, right? Let us check on this first. So what I'm supposed to be doing, I take the total, the cost of the assets which are included in the factory billing. The first one is the building house, which is 1180,000. 1180,000, right? Plus the office block, which 1.2 million. Plus the other one given there is a shop of 800,000. 800,000. Then I have a showroom of 600,000. So how much is this? How much is this? So I take my calculator. How much is this? Joy, how much is this? How much is this? I think I'm getting that 780,000. So that 780,000 is the total for these assets. Then you divide by the total cost of the factory building. The examiner has given you the factory building equates to 8 million. So you divide with 8 million, then you multiply by 100%. So how much is this? How much is this? I'm getting 47.25%. I know that we are following. 47.25%. So this, it means I have to restrict. I just write for you here, restrict. So it means this cost or these values qualifies for IBD. They qualify for IBD. They qualifies for IBD at the rate of 25%. I think I'm very clear about it. Though these costs qualify for IBD. So what am I going to be doing in the factory building? I take 8 million, I subtract that 780. So let me do that here. 8 million minus that 780,000. 8 million minus 3780,000. I'll be able to get 4220. Now, the qualifying cost in the first year of the investment deduction, we have said is 50%. So 50% of the qualifying cost is how much? 50%. Here I should be having the ID amount. Sorry. ID amount. Then here we talk about residue carried down. So the ID amount will be 4220. I multiply by 50%, which I get 10,000, right? So the residue will be, you take the qualifying cost minus your ID amount, which I'm going to be getting 2110,000. 2110,000. That is how I will do with factory billing. Then I will be able to proceed. The second one is the processing machinery, which form part of the investment deductions. Processing machinery. I'm given 2.4 million. I just put it here. Right? The ID at 50%. So 2.4 by 50%, which I get 1200,000. So the residue value will be 1200,000. 1200,000. I'm given saloon car, which does not qualify for ID, neon sign, which does not qualify here, computer delivery van, furniture and fitting, water tank, but we have water pump. Water pump. So water pump qualifies for ID. I'm given 40,000. I'm given 40,000. I could see there is an area. I was able to make an error. when I look on the processing machinery before I proceed with the water pump, there is an additional information which touches for processing machinery, additional information too. I've been told that the processing machinery excludes an interest on loan of 240,000 shillings paid for a loan of 2 million, which that does not concern us, used to acquire the machinery, that is not our concern, and installation costs amounting to 60. So what is the total cost of the processing machinery? Will be the total cost of the purchase, which is 2.4 million, plus 60. Plus 60. So in this case, the total cost, the qualifying cost for the processing machinery will be 2460,000. 2460,000. So you grant them ID at the rate of 50%. We are getting 1230. We are getting 1230,000. So it means here the balance is 1230. Now, when you look on the water pump, let me come again to the water pump. I'm giving the qualifying cost at 40. You grant ID at the rate of 50%. So it means it's 20,000. So the balance goes to the residue for 20,000. Now, from water pump, I'm being given the computer software. We have the lorries. All those assets qualify for the other problem there. Now, when I look on additional informations, there is no any other asset which qualifies for ID, So what am I supposed to do? I'm supposed to be getting this summation for the ID amount. Hii ndio unatumia kwa income statement now. This one, right? This is the one that you use for income statement. I will be able to show you how you use this information when we do last semester's question, right? So just stay tuned. Plus 2110 plus 20,000. So here we are getting 3360. 3360. That is how simple it is to get ID. I just want now to do IBD. Just want us to do IBD. Industrial building deductions. 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 And when I look on the industrial building deductions, this is how you are going to be writing your format. So IBD. So the format will be looking like this. We have the nature of assets, right? We have qualifying costs. We also have IBD rate. We have IBD amount. Then we have residue. Residue carried down. Now, I just want to look on the assets, and I will start with the additional information number 1. There are assets that you have already excluded from the factory building costs. Those assets qualify for IBD, right? Because their cost exceeds 10% test. They include, number 1, we have dwelling house. So let us proceed. I have said after you write your format, there are some of the assets that you have already excluded from your factory building, and they qualify for IBD because they exceed the 10%, and they include the dwelling house. The qualifying cost for this dwelling house, I'm being given 1180. Right, I was able to subtract 1180,000, which already we have the dwelling house of 1180. We also have We also have what? Good. We have office. Office of how much? Office of 1.2 million. Right? Office of 1.2 million. The other one, we have shops. Shops of shops. We have shops of 800,000. And then we have showroom. The showroom of 600,000. 600,000, right? You remember there is an additional information I have already given you. The point to note, I have said that when all assets, there is a point I wrote down somewhere. A minute I check on it. I was able to give you a good point to note. One minute. Good. We say that the above, which we say they normally include the showroom, retail shops, offices, administration block. We have caretakers dwelling house. They always qualify. We have said the above items, even including the factory building, will only qualify for capital allowances if their value do not exceed 10% of the total cost of investment. And we have already done that. But there is another area where I was able to tell you that the cost of the showroom, retail shop, caretakers dwelling house, administration block all qualify at the rate of 25%. So here they qualify for 25%. That is their rates. 25%. 25% each. So in this case, I just say 1180,000 times 0.25, we are getting 295,000. So to get the residue carried down, I will take 1180,000 minus answer, and I will be able to get the residue carried down of 885,000. The second one, it will be 1200,000. I multiply by 0.25, right? I'll be able to get 300,000. So 300,000, this means the residue carried down is 900,000. The other one is 800,000 times 0.25. I'm getting 200,000, which equates to 600,000. Then we have 600,000 times 0.25. We are getting 150. And this equates to 450. So the total for the IBD is how much? Not the total, by the way. There are any other assets which qualify for IBD. Now, in this case, let me look for additional information. I've been told this, note number 5. I've been told this, a section of workers' quarters burned down by fire has been renovated at a cost of 1.5. The remaining section which has not been affected by the fire has been valued by insurance company at 1 million. So in this case, we are not factoring the cost of compensation by the insurance company. What is important is you ask yourself, how much is the staff canteen, right? How much was the staff canteen? We have been told the staff canteen was constructed during the year at 840. So this is what you do under the IBD. I'll just be able to tell you a simple thing. Adjust the dates the assets was put in use, into use. And that applies to IBD only, not to any other capital allowance, to IBD only, Now, in this case, I start with staff canteen. Staff canteen, the qualifying cost you give are the one given by the examiner, which is 840,000. The IBD rate is 10%. 10%. So in this case, the IBD amount is going to be a portion. It is not for the whole year because this asset was put into use during the year. So how much is this? So I say 840,000. I multiply by 10%. Right? You get 84, but 84 is for the whole year. But now, during this financial year, because we are calculating for this year, the asset was put into use from September 1st. So you count how many months? September, October, November, December. So your portion, you take 840,000 times 10% times 4/12, right? That is how you do here. But here you write the whole amount. So if there is anyone who is copying you in an exam, hatajua kwa nini umepata that figure. Sawa? So just do that, your portion, and here you are getting 28,000. Mtu atashangaa hii figure umetoa wapi? 28,000 is the IBD for this year for staff canteen. So take 840,000 minus 28,000, and you are going to be getting the residue of 812,000. Now, let us proceed to the last note. We are being told a section of workers' quarters, which qualifies here. Workers' quarters, we are being told the cost was 1.5 million, which is okay. The rate is 10%, right? But we are being told it was put into use from October 1st. So how many months during the year? So you do the same. You say 1.5 million times 10% times 3/12. 3 months. October, November, December, 3 months. Right? So it will be 1.5 million times 0.1 times, right? 3, you divide by 12. I'm getting that 7.5. That's 7,500. What is the residue carried down? I take 1.5 million minus answer. I'm getting 1462,500. What is the IBD amount now? So I do the summation. So in this case, I take 37,500 plus 28,000 plus 150,000, right? Plus 500,000 plus 295. We are getting 500. That is how you do IBD. Now, I just want to do the last one, the last capital allowance here, which it is normally called WTA, wear and tear allowance. Wear and tear allowance, where there is no any adjustment of dates. Hapa to adjust anything. Wear and tear allowance. In wear and tear allowance, we said it's very simple. We normally have 2 classes. Tuko na class 1 at the rate of 25%. Right? Now tuko na class 2 at the rate of 10%. So tulisema hivi, you normally start with the written down values. Kama ziko. Then the assets zenye tunanunua hii mwaka zinaitangwa additions. Assets zenye tumenunua during the year zinaitwa additions. Now, in this case, let me look for any asset which qualify for WTA. We have the factory building tumemaliza nayo, processing machinery tumemaliza nayo, tuko na saloon car. Saloon car given ni ya 2.8. Tulisema ina qualify class 1. 2.8 million, right? So you will be able to ask me, why am I putting 2.8? And I was able to put a note somewhere in my notes that the saloon car is restricted to 3 million. I say if it is below 3 million, you put the whole amount. If it is above 3 million, you put 3 million restricted. Hapo unaandika tuka R. We are going to be having a question for that problem. After the saloon car, we have neon sign. Tuko na neon sign. So the neon sign qualify for class 2 at 48,000 naeka per the whole amount, right? The other one we have computers. Computers tulisema they qualify for class 1. Now when I look on my computers here, which is 150,000. 150,000 naeka up 150. We have delivery van. Delivery van nilisema ina qualify class 1, nimepewa 960,000. 960. Now we have furnitures and fittings. I'm given 200 which qualify for class 2. 200,000. Then I have water tank. Here tumesema kwa ndoo zetu, the water tank qualify for class 2. I've been given the value of 90,000, right? Then from there we have computer software. Computer software we said is class 1, 120,000. 120. Then we have lorry. Niambiwa hapo ni 3 tons. Class 1, I'm being given 2750. 2750, right? Now, after this, you look on the disposals, because najua kuna disposals. Disposals is very easy. Na kufanyia pia ya saloon car, kama itakuwa restricted here, is the only one that the examiner tries to confuse students. Note number 3, I've been told the saloon car was disposed of on 1st December 2014 at 180. Saloon car, unaandika hapa. Saloon car, tulidispose na 1.8. Subtract. So what are you supposed to be getting here? We are supposed to be getting qualifying costs. Qualifying costs I'm supposed to be getting there. So let me calculate the additions for the class 1 first. So 2.8 million plus 150,000 plus 960 plus 120 plus 2750 plus, minus 1.8 million. I'm getting 49,80,000. Ushapata hii, calculate your WTA. How am I going to be getting it? I take my rate, I multiply by the qualifying cost. Rate, I multiply by the qualifying cost. So I just multiply by 25%. I'm getting 1245,000. How am I getting the written down values? The written down values, I'm going to be getting them. The written down values, I'm taking 49,80,000 minus answer, and I'm getting that 735. Good. So I have said that the qualifying cost will be 49,80,000. To calculate my WTA, I'm going to be taking 25%. I multiply by the qualifying cost, right? I get it. Then to get the written down value, subtract. Let me go to class 2. I will take 48,000 plus 290,000. I'm getting 338,000. 10%, it will be 33,800. So what will be the written down values? So I say 338,000 minus 33,800. You are going to be getting 304,200. Sasa hii ndio unatumia the summations ya hii na hii unazitumia kucalculate the adjusted taxable income if you are computing the adjustable taxable incomes. But I will be able to show we have that problem from our previous question for 2022 August. We shall be able to do that problem. That is how you do the capital allowances. Already, I have all the mark the examiner was looking for that question, was looking for me to be able to tackle it from that question. Now, I just want to do another question. Here. And the question that we are going to be doing, I just want to focus on last semester's question. 2022, there was a bit of challenging question, but once you understand the capital allowances, you will be able to get all the marks. You'll be able to get all the marks. The question needed a lot of knowledge. You needed a lot of knowledge from all the areas you have tackled in taxation, right? So it needed all the knowledge from the capital allowances, business income, and so on and so forth. But it is not a tough question if you are able to internalize it very well. So it was August 2022 question 4B. Na hii maswali inakujanga tu hapo. Between 3 and 4, they normally fall there. So someone will be able to read for us, and that someone is Joy. August 2022.
Pakim Limited, a large manufacturing company.
A minute please, hata mimi nifungue hapa. Tufungue hapa. Haya, tuendelee sasa.
Pakim Limited, a large manufacturing company, has provided the following statement of profit and loss for the year ended at 1st December 2021. Gross profit, less the expenses and loan repayment, directors' fees, VAT paid, depreciation, salaries and wages, donation to a political party, interest expense, installment tax paid, dividends paid, repairs and maintenance, then you get the net profit for the year. Additional information. On 1st January 2021, Pakim Limited purchased the industrial building from Samba Limited, a contractor, for shillings 200 million. The following details were available that comprised the total purchase price for the industrial building. Land, donation of building site, labor quarters, factory building, perimeter wall, drainage and sewage system. The factory building above house of allowance costing shilling 7 million, and administration block costing shilling 7 million, and a showroom at a cost of shillings 4 million. Pakim Limited purchased and installed a processing machinery in the factory at a cost of 40 million on 2nd January 2021, and started manufacturing leather products. The cost of processing machinery included workshop machine and a boiler at a cost of shillings 5 million and 6 million respectively. The following additional assets were acquired during the year ended at 1st December 2021. On 1st January 2021, computers were acquired on a hire purchase at shillings 620,000. Hire purchase interest included shillings 40,000. Acquired furniture and other machines at shillings 720,000 and shillings 968,000 respectively. On 15 March 2021, Pakim Limited bought a pickup for shillings 2,250,000 and a motorcycle for shillings 190,000, a water pump for shillings 48,000, and the two delivery trucks for shillings 5 million each. Two saloon cars were purchased at shillings 3,600,000 each in April 2021. In October 2021, one saloon car was involved in accident, and the insurance company paid shillings 2 million as compensation. In November 2021, the pickup vehicle was traded in a new delivery van valued at shillings 3 million. The pickup and a value of shillings 1,600,000 at the time of the trading. Interest expense included hire purchase, interest for computers, interest on overdue loan, provision for interest on loan to be obtained to expand the business, interest to unpaid tax. Gross profit included anticipated foreign exchange gain of shillings 2 million and a reduction in general bad debts of shillings 620,000. Required Pakim Limited's investment and allowances for the year ended at 1st December 2021. Ascertain the taxable profit or loss for the year. Then number 3, explain the tax treatment of tax losses.
So you can see a question is having a lot of information. but all this information is just from our previous knowledge that we have already acquired from other topics that we have already tackled. So it means this question has incorporated the business income knowledge together with the capital allowances. It needs us to work on the two areas. So in this case, I just want us to look on I just start with the capital allowances because I can see note number 1, which is 8 marks. The examiner is asking me to calculate the Pactim Limited investment allowances for the year ended at 1st December 2021. So in this case, where should I start? I say the only area I can be able to start this question is from industrial or investment deduction, sorry. So I will be able to look on the nature of assets, right? We look on the qualifying costs. We talk about ID at the rate of 50% now, because we said we grant 50 in the first year. Then we have ID amount. Then we have the residue carried down. We have the residue carried down. Now, we look on the assets which qualify for investment deductions, right? That is the thing that I have to be checking from the question given. So this is what you have to do. So let me start from the information given up there in note number 1. I've been told on 1st January 2021, Pactim Limited purchased an industrial building from Samba Limited, a contractor for 200 million. So the details were availed that comprise the total purchase price for the industrial building. I said land does not qualify for any capital allowance. Therefore, I'm not supposed to even thinking about giving it any capital allowance. Now, we go to the demolition of old building. It is here. Demolition of old building. What is the qualifying cost for this? I'm being given 10 million. Now here we limit 10,000. The rate is 50%, right? 50%. So 50% here, I'm getting 5,000. So here it will be 5,000. Let me look on any other asset which qualify for IB, apart from the demolition. We talked about labor quarters for IBD. We have factory building. Factory building. So how much is the factory building? I'm being given 90,000. 90,000. So it will be 90,000 here, right? 90,000. But now I look on the based on the information given there, I've been told clearly that the factory building above included or above houses a warehouse costing 7 million, administration block costing 7 million, and a showroom at 4 million. Look on the 10% test. 10% test. So I will be able to take the cost of the warehouse, which is 7,000, plus the cost of administration block, which is 7,000, right? Plus the cost of showroom, which is 4,000. This is equivalent to 18,000. You divide by the total of the factory building, which is 90,000. Then you multiply by 100%. Look whether it exceeds 10%. Look on whether it exceeds 10%. So 18,000 times, divide by 90,000 times 0, okay, 18,000 divide by 90,000 times 100%. I'm getting 20%, which exceeds 10%, which is greater than 10%. So in this case, I just say restrict the above items. I restrict the above items. Restrict the above items. Now, in this case, it means 90,000, I will be able to subtract 18,000 to remain with the cost of factory building only. So in this case, it means I just need to take 90,000. I subtract 18,000. I remain with 72,000. 50% of 72 is 36,000. So it means my balance is 36,000. That is my balance after the factory building. We are going to be having Factory building, we have perimeter walls. We have perimeter walls. So perimeter walls is how much? I'm being given 5,000. So it is 5,000. 50%, it will be 2,500. And on the other side, it will be 2,500. Those are the perimeter walls. The other one will be drainage and sewerage system. Drainage and sewerage system. Drainage and sewerage system, we are being given how much? 13,000. 50%, we are getting here 6,500. And also here, 6,500. Now, in this case, I just look for any other thing that qualifies for capital, for investment deductions. I've been told in note number 3 that the Parking Limited purchased and installed processing machinery in the factory at a cost of 40 million. So we have processing machinery. We put it down here. Processing machinery, which is 40,000. 50%, we have 20,000. Here we have 20,000. 20,000 there. Now, the other thing which they were able to purchase, I'm being told, the cost of the processing machinery include a workshop machine and a boiler that cost, all those qualify for investment deductions. Now, do we have any other thing that qualifies here? Right? Any other thing which qualifies for investment deductions? I'm just checking now. Make sure that we have included everything. We've included everything? No. When you look on note number 4, subsection 3, we have been told on 15 March 2021, Parking Limited, bought a pickup of 2.25 million, motorcycle for 190,000, a water pump, which qualifies here. Water pump. So my water pump qualifies here is how much? Water pump given. That's okay. So the water pump is 48,000. The ID rate is 50%. So it means this 24,000 and this one is 24,000. So how much is this? How much is this? So we have 24,000. 24,000, right? Plus 20,000 plus 6,500 plus 2,500 plus 36,000 plus 5,000. I'm getting wrong answer. This one, it should be 48. Because it's 48,000 and we have limited our figures to 48. That is okay. That is very okay. It should be 24. So it should be 5,000 plus 36,000 plus 2,500 plus 6,500 plus 20,000 plus 24. I'm getting 70,000 and 24. 70,000 and 24. That is investment deduction. Let us go to IBD. Let us proceed to IBD. Let us proceed to IBD. We have nature of assets. We have qualifying costs. We have IBD rates. We have IBD amount. Right? IBD amount. Then we are going to be having residue carried down. Residue carried down. Kumbuka kuna assets zenye ulitoa kwa factory building, right? So you start from that angle. So in this case, when I check here, when I check from our question here, those assets included, we have warehouse, right? At the cost of 7,000. We also had the administration block. Administration block at the rate of 7,000. Then we also have showroom at the rate of 4,000. So the IBD rate here, we said is 25%. A quarter, 25%. So what is the IBD amount?
$1,750.
Sorry?
$1,750.
1,750.
For the warehouse.
Is how much?
For the warehouse, it's 1,750.
1,750. For administration block, 1,750.
Yeah.
Showroom. Is 1,000.
Yeah.
So this is 3,000. The other one is
5250.
sorry,
5250.
5,250.
Yes.
Now we look on the other asset which qualifies here, and I could see that we have labor quotas somewhere in note number 1. So the labor quotas zilikuwa za ngapi? Labor quotas in this case, they were how much? 60,000. 10%, 6,000. I think here is 54. How much is this? Is IBD amount. That is IBD amount. Right? How much is this? 10,500. Is it 10,500? Are we together?
Yes.
Let us go to WTA. Let us go to WTA. We say WTA, the assets are grouped into 2. We have class 1, we have class 2. The rate here is 25%. The rate here is 10%. So we say we normally start with the written down value if they are available or if they are given. So the assets that we are purchasing during the financial year, they are normally called additions. Now, in this case, we just look on the assets which qualify here. And already in note number 2, we have completed. Note number 3, I have been told that we have some assets which qualify there. You have been told the factory building, the factory purchased and installed processing machinery. I think that point we are also clear with it. Note number 4, I've been told that the following additional assets were acquired during the year. We have the computers on 5th January 2021. Computers were acquired and on a higher purchase of 620. But we have been told that the higher purchase interest included 140. So in this case, the cost of computers will be how much? You take 620, you minus 140, with the included, this is an interest for hire purchase. So you exclude 140. And in this case, I'm going to be getting how much? How much is this? 620 minus 140, I'm getting 480, which qualify for class 1. Then we have another one. We have been told acquired furniture and other machines at 740, 720, and 968. So we start with furniture. Furniture of ours, which qualify for class 2, amounts to 720. Right? Then we have been told there that we have other machines which follow the same suit, which qualifies for class 2, 968. 968. Now we have on 15 March 2021, Pactim was able to buy a pickup of 2250, right, which qualify for class 1, a motorcycle of 190, right, 190, a water pump, which you have already tackled it, and we have delivery trucks. Delivery trucks. He has told us that he was able to acquire delivery truck of 5 million each. Once you multiply by 2, you get 10 million. So here is 10,000. 10,000 like that. Then you have been told 2 saloon cars were purchased at a cost of 3.6 million. Saloon cars, we say any cost that exceeds 3 million, right? It is restricted. So it means I will be able to take 3 million restricted. You multiply by 2. Because 1 is 3.6. So it will be 6,000. You write here restricted. You write there restricted. That is what I was meaning. In October 2021, one saloon car was involved. An accident insurance company was able to compensate us with 2 million. I'll be able to come back there. Now, in November 2021, a pickup vehicle was traded with a new delivery van. So in this case, our delivery van is costing how much? Delivery van, 3 million. Delivery van tumepewa 3 million. Delivery van tumepewa 3,000 actually. Sorry. Delivery van of 3,000. So in this case, we have been told 3 million. The pickup at a value of 1.6. That is not a problem. Any other problem? I think we don't have any other problem. We have done with how much furniture. Anything we have left out? Anything we have left out? Motorcycle, we said it to qualify for. It should be here, sorry. It should be there. That is what I was checking. Now, in this case, we have disposals. We were able to dispose 2 things. There was a pickup which was disposed. So the pickup is amounting to how much? I'm being told there that in November 2021, the pickup vehicle was traded with another one valued at 3 million. So the pickup had a value of 16. So tuliongezea 1.4. So we ended up parting ways with 1,600,000. Now the other one is saloon car. We have been told there was a compensation for saloon car. So this is how you normally do the disposal of a saloon car in case of restriction. You normally take the cost, the value that this vehicle was sold or was compensated with. In our case, saloon car was compensated with 2,000, right? You divide by the original cost of that saloon car, which was 3.6. Remember, it was only 1. Then we multiply by the restriction value, which is 3,000 now, based on my figures. I have said you take the costs that was compensated, which is 2,000. You divide by the original cost of that saloon car. Then you multiply by the amount that you're restricting with. So 2,000 divided by 3.6. Then you multiply by 3,000. It should be, I think it should be 166.7. It should be something like that. It should be something like this. Now, after I do this, I will rush very quickly to get the qualifying costs. So the qualifying cost will be how much? So 480 plus 2250 plus 190 plus 10,000 plus 6,000 plus 3,000 minus 1,600 minus 1,667. I'm getting 18,653. Then we have 720 plus 968, which is 1,688. Then here we have the written down values, the wear and tear allowances. I take the proportions now. I multiply with the qualifying cost. Let me start with this one. I will get 168.8. Then the other one will be 18,653 times 0.25. I'll get 46,63.25. Right? Now, in this case, the written down values of mine zitakuwa ngapi? The written down values. So the first one will be 18,653 minus my answer here, and I'm getting 13,989.75. Then we have 16,88 minus 168.8. I'll be able to get 1519. 1519.2. That is what we are going to be doing. So in case of capital allowances, what am I going to be using? This is what we are going to be using for capital allowance. So you take the summation of 2. Then wakati unafanya the adjustment of the adjustable taxable profits. Now this is what you normally take. This plus this is how much? Let me write it there. 4663.25 plus 168.8. You'll be able to get 4832.05. 4832.05. I just want to proceed now to do the last part of the question. Because I've been told to ascertain, part 2, I've been told to ascertain the taxable profits or loss for the year. So this is what I'm supposed to be doing now. After the computation of all this is what you're supposed to do. This is what you're supposed to do after you do all that work. Now, in this scenario, this is what you normally do. So here we are doing the question for April. It should be 4C. Should be 4C. Or is it 4B? It should be 4B. It should be 4B. So I just want us to do the question very quickly. We're just finalizing. So in this case, we are doing a question for Parking Limited. Parking Limited. We are doing for which year? We are being told it's 2021. Adjusted taxable income, stock loss, computation. So I just have to have 2 columns for Kenya shillings, yeah? I think we should be limiting them to thousands in that manner. in that manner. Just we are repeating what we have already done in our previous sessions. So the net profit given here, the reported profit of ours is 51. I'm being given clear there. This 51.65. So the reported profits, we have said it is 51.65. We said we normally had disallowable. Disallowable expenses. So in this case, the disallowable expenses of ours, right? The disallowable expenses, these are the expenses, as I reiterate again, they are the expenses which they do not relate with the operations of the business. That is why they are normally called disallowable expenses. Let us identify them from the additional information. Now, I will start with note number 5. I've been told the interest expense were inclusive of higher purchase interest for the computers, which is okay. But we have the interest on overdue loan, which is a disallowable expense for overdue loan. It is a disallowable expense, amounting to 200, right? From there, I've been told provision for interest. We say the only provision we can be able to allow under the tax is the provision for specific and doubtful debts. So any other provision is a disallowable. So provision for interest expense. Provision for interest expense amounting to 752. Now, as we move forward, we are being told interest of unpaid tax. Interest of unpaid tax, it is a disallowable expense. On unpaid tax amounting to 448. There is another thing that I've been told there. We are being told the gross profit include anticipated foreign exchange gain of 2 million and a reduction in general bad debts of 620. We are going to be adjusting those later. We know that. We are going to be adjusting those later. So kama uko na paper, you just put star. I will come back later there. Let us go to the statement that I was given here. The expenses which have been given, I can see that after the gross profit, they were able to subtract the general expenses. We have loan repayment is a disallowable expense. Loan repayment amounting to 1,600. Now we are being told director's fees, which is okay. VAT paid. We don't have to include the VAT. We normally pay VAT out of the income generated. We are here to generate the income. So that is where the VAT paid can't be treated as an allowable expense, right? It can't be treated as an allowable expense. That is why we are treating as a disallowable expense. 2,700. Depreciation, we said we don't recognize depreciation. Depreciation amounted to 5.7, right? And I've been told we have donations to a political party. We say the only donation we can be able to accept it to charitable organizations. Donation to a political party amounting to 780. 780. We have interest expense, which is okay, but I've been told there we have installment tax paid. Installment tax paid amounted to 600. Now we have dividends paid. Dividends paid are not allowable expenses, and you know that. We normally pay dividends from the income generated, the income. Now, after the net profit of the year, tungelipa dividends, but you can't treat them as allowable expense of the business, amounting to 1,005, sorry. I don't think if there is any other thing that is under the disallowable expense. That is okay. So let us subtract. Let us less allowable now. Expenses stroke non-taxable incomes. And we can start with the capital allowances of ours. Then you may pattern. Then you may calculate. So we start with ID, IBD, and WTA. So ID ulipata ngapi? ID ulipata ngapi? What I remember, IBD were able to get 10,500. Right? ID, we were able to get 70,024. Then WTA, we were able to get 4832 point something. Let me use what I have here. 4832 is close. What we got is close to that. Then we have non-taxable incomes under note number 6. Note number 6, where we are being told the gross profit included foreign exchange gain. You subtract it here also. Foreign exchange gain amounting to how much? 2,000. Right? 2,000. Then we have reduction in general. And you know that right now. In general. Reduction in general budgets. Reduction in general budgets amounting to 620. Amounting to 620. I know that is very clear. Amounting to 620. Now, in this case, let me just finalize. So we take the first one. We have 200 plus 752 plus 448 plus 1600 plus 2700 plus 5700 plus 780 plus 600 plus 1005. This is 13, 785. So the other one will be 70,024 plus 10,500 plus 4832.123 plus 2,000 plus 620. This is 87,976.123. So what will be the total here? So I'll be able to take 5165 plus 13,785 minus my total deductions, about 87, minus my answer, which I'll be able to get a loss, right? So in this case, I will be able to get a loss, adjusted taxable loss of how much? I'll be able to get 69,026.123. This is a loss. That is a loss. Now, what the examiner is asking you there, the examiner is asking number 3, a very simple question. The examiner is asking that explain the tax treatment of tax losses. The tax treatment of the tax losses in Kenya. And we can just say this. Tax losses in Kenya, are carried forward tax losses are carried forward as allowable deductions are carried forward as allowable deductions against future income arising from the same source. Such a loss is carried forward indefinitely. Such loss is carried forward indefinitely. Carried forward indefinitely. Carried forward indefinitely, effective 1st January 2022. Effective 1st January 2022. I just want to give assignments. Just want now to give assignments. Now, the first assignment you'll be able to do December 2021. December 2021, question number 4C. The other one is September 2021. Question number 4C. The other one will be May 2021. Question number 4B. And then also you do another question for which year now? You do for May 2016. Do for May 2016, question number 4B. Question number 4B. Now, because we are almost finalizing, I will be able to check on the assignment that I know you have shared with me. You have assignments, a lot of assignments that you have already shared with me. I will be able to check on them. And therefore, I shall be able to share the findings in the course of the week. Any question? Any question?